All participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Suraj from CDR India. Thank you, and over to you, sir.
Thank you, Neerav. Good afternoon, everyone, and thank you for joining us on Max Healthcare Q1FY26 earnings conference call. We have with us Mr. Abhay Soi, Chairman and Managing Director, Mr. Yogesh Sareen, Senior Director and Chief Financial Officer, and Mr. Keshav Gupta, Senior Director, Growth, M&A and Business Planning. We will begin the call with opening remarks from the management, following which we will have the forum open for an interactive Q&A session. Before we begin, I would like to point out that some statements made in today's discussion may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Abhay to make his opening remarks. Thank you, and over to you, Abhay.
Good morning, everyone, and thank you for joining us on Max Healthcare's first quarter FY26 earnings call. We are pleased to report a strong start to the financial year with a year-on-year growth of 27% in revenue and 23% in operating EBITDA for the network. This marks the 19th consecutive quarter of year-on-year growth, underscoring the success of our strategy and strong execution capabilities of the team. This performance is driven in part by the successful integration of the hospital acquisitions made in recent years, which have significantly bolstered both our top and bottom line results. Looking ahead, our focus remains on commissioning the new bed capacities scheduled to come on stream during the course of the year. We expect to add approximately 1,000 brownfield beds and 500 greenfield beds. Trial runs have already been initiated at the new 160-bed brownfield tower at Max Mohali. In addition, our board has recently approved the execution of an agreement to lease for a build-to-suit 130-bed hospital in Dehradun. The site is located approximately 100 meters from our existing 220-bed Max Dehradun facility, which reported over 80% occupancy in the first quarter FY26. The new facility is expected to be commissioned by the end of 2028 and will primarily focus on advanced oncology services, including radiation therapy, which is presently missing at our Max Dehradun facility. As part of our strategy to focus on super specialty care in selected geographies, we have executed a binding term sheet to divest Chitta and Anoopshahr hospitals for rupees 40 crores, with completion expected by September 2025. Of the two, only Chitta Hospital was operational and reported approximately rupees 5 crores in revenue and rupees 1 crore of EBITDA loss in the first quarter FY26. These assets were part of the overall JP Healthcare acquisition and had limited strategic alignment. Now coming to the performance highlights of the first quarter. Please note that the term existing units hereafter refers to the network facilities that were operational prior to Q1 FY25, while Max Noida and Max Dwarka are categorized as the new units. Average occupancy for the network stood at 76% compared to 75% in both quarter 1 last year and the trailing quarter. However, existing units achieved occupancy levels of over 78%. Occupied bed days increased by 26% year-on-year and 4% quarter-on-quarter. Average revenue per occupied bed for the quarter was rupees 78,000, growing nominally by 1% year-on-year as well as quarter-on-quarter. For the existing units, like-for-like ARPOB grew by 5% year-on-year and 2% quarter-on-quarter. Network gross revenue was 2,574 crores, up from 2,028 crores in Q1 last year, and rupees 2,429 crores in the previous quarter. This reflects an increase of 27% year-on-year and 6% versus the trailing quarter. Of this, new units reported a gross revenue of rupees 231 crores. Like-for-like revenue growth in existing units was 16%, driven by an increase of 10% in occupied bed days and 5% in ARPOB. Digital revenue from online marketing activities, web-based appointments, and digital lead management was rupees 744 crores, accounting for approximately 29% of the overall revenue. Website traffic witnessed over 69 lakh sessions during the quarter, growing by 61% year-on-year and 7% quarter-on-quarter. International patient revenue reached rupees 208 crores, registering a growth of 32% year-on-year and 3% quarter-on-quarter, despite airspace restrictions and geopolitical volatility in certain regions. Network operating EBITDA stood at 613 crores, reflecting a growth of 23% year-on-year and a 3% dip quarter-on-quarter, primarily due to the impact of annual increments and additional manpower hired for new capacities. New units contributed rupees 27 crores to the network EBITDA, representing a growth of 19% compared to trailing quarter. Network operating EBITDA margin was 24.9% for the quarter. Existing units reported an EBITDA margin of 26.2%, which is 44 basis points higher than Q1 last year. Also, adjusted for the one-time donation of rupees 12 crores, the margin increased to 26.7% for existing units. Annualized EBITDA per bed for the network stood at rupees 68 lakhs. Like-for-like EBITDA per bed for existing units was rupees 75 lakhs, reflecting a 7% growth year-on-year. Profit after tax for the network was rupees 345 crores versus rupees 295 crores in Q1 last year and rupees 376 crores in the previous quarter, reflecting a growth of 17% year-on-year. Free cash flows for the quarter were 389 crores. We deployed rupees 435 crores towards ongoing capacity expansion projects and facility upgrades at newer units, while rupees 131 crores was spent towards land purchase for brownfield expansion at Max Vaishali. As a result, net debt for the network stood at 1,755 crores compared to 1,576 crores at the end of March 2025. Continuing our efforts to support the local communities, we provided free treatment to approximately 40,000 patients from economically weaker sections of the society, worth rupees 62 crores at hospital tariff. Both our strategic business units continued to report steady growth in their revenue and profitability. Max at Home reported a top line of rupees 60 crore, reflecting a robust growth of 22% year-on-year. It offers 15 specialized service lines across 15 cities with over 50% repeat transactions. On the other hand, Max Lab reported a revenue of rupees 48 crores, reflecting a growth of 19% year-on-year. It provides services in over 55 cities through its network of more than 1,300 collection centers and active partners. Now coming to the status of our expansion projects. Firstly, the 268 beds at Nanavati in phase 1. We are in the advanced stages of commissioning 3 basements ground to 3rd floor along with 7th floor over the next few weeks. 400 beds of Max Smart and Saket complex. The interior and MEP fit-out works are progressing as planned, with phase commissioning expected to start towards the end of Q2FY26. Max Lucknow. The current capacity of the hospital stands at 413 beds, and we expect this to increase to 520 beds by end of the financial year. Of the 107 additional beds, 32 beds are ready for commissioning. The onco bunkers are also, this is the oncology bunker, are also in advanced stages of completion, with LINAC installation expected to start in early September this year. The 500 beds at Sector 56 Gurgaon. Structural MEP work is currently in progress with high-side equipment under installation. We expect to commission the facility by the end of this financial year. 100 beds at Max Nagpur. We are currently awaiting formal environmental clearance. While the project has been otherwise approved, civil contract has been awarded. We expect to complete within 24 months. 397 beds at Patparganj. Post receipt of environmental clearance, barricading and tendering work is in progress. The D-wall designs, etc., has been done, and work is now being awarded accordingly. This is also in line with what we had projected. 550 beds at Max Vikrant, Saket. We are still awaiting clearance from the Forest Department for tree transplantation. A fresh application has been submitted in line with discussions with the department. Any which way, this project is to start upon commissioning of the 400 beds at Max Saket by the end of this year. The 400 beds is Zirakpur, Mohali. The partner has received approval for the drawings and construction, and site work is progressing at a very fast pace. The project is expected to be completed within the next 24 months. 140 beds at land adjoining Max Vishali. Demolition of the existing structure is underway, and the building plans are being filed with the authorities. We expect to complete this project within the next 30 months. 500 beds at Thane. Partner is in the process of finalizing the master plan for the larger site. Detailed drawings for the hospital are being prepared, and we expect submissions to begin by the end of this quarter. The 250 beds at Pritampura, Delhi. Partner has submitted the drawing for approval. Site cleanup and barricading works have been completed, with construction work to commence upon receipt of necessary approvals. With this, we open the floor for any questions you may have.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Tushar Manudhane from Motilal Oswal. Please go ahead.
So thanks for the opportunity. So just in terms of the operational beds has increased by almost 25%. So and that is how the revenue growth it seems to be with given the stable ARPOB at the headline level. So if I exclude these additional operational beds which would have happened over last 1 year, then the remaining beds of performance, how it has been, if you could throw some light.
So, like I mentioned, the existing beds is what we are calling what opened in the last 12 months. So Dwarka opened in July, and JP Noida was acquired in October, November. So if I just take these two facilities out, then the growth in revenue has been 16%.
And that is driven again by further sort of optimizing payer mix, or is it a combination of?
No, let me just say this. So then basically, the existing hospital, that means including the Lucknow and Nagpur, the growth has been 16% and 18% as I mentioned. Right? If we take out the two new hospitals that we added in this, basically the Lucknow and Nagpur, which the acquisition happened in the quarter 4 of the FY24. So in that case, the growth will be, if I take that out, then the growth will be around 13% in the revenue and around 15% in the EBITDA. So that means even the base level existing hospitals, even taking out Lucknow and Nagpur, the revenue is quite robust.
Got it, sir. And so subsequently extending to this, now.
And also I want to mention that in that case, the growth in ARPOB will be 7% instead of 5% that I mentioned over the existing hospitals. So that means the base level existing hospital growth will be, ARPOB is 7%, 5% in the OBDs, and overall growth in the revenue will be 13%.
And of course, the occupancy would be any case going sort of 80% plus, right? I mean, because the headline occupancy itself is at 75-76%.
No, I think
in the base level hospital will be around 79.9% in this quarter.
But if 79.9% is almost 80%, okay, in the quarter base hospitals. But if you add Lucknow and Nagpur to it, okay, then it comes to 78%. But then if you add the other two which we did last year, then it comes down to the 76%, which is similar to what it was last year.
Got it.
Get it?
So that's what. Yeah, fair. I mean, The further extension to this is that if I exclude these new, whatever that got added over last year, then the base hospitals may, given that we've already grown in this year as well, and we are already at 80% occupancy.
That's
So
right. But you see, I just want to tell you, no, I want to just tell you, see, we are calling existing hospital, the 2 hospitals which were added in the last 12 months, right?
Yeah.
But if I extend this argument to 15 months, then it becomes 4 hospitals. So therefore, I'm just telling you, from existing hospitals, we are only counting the 12 months. In spite of that, the occupancy has gone up from 75 to 78%.
Got it.
But if I take out the 2 which were added in the month 13th, 14th, 15th, last March, then it goes to about 80%.
Got it. No, so subsequently, new growth because of these new additions is very much intact.
Of course.
We, for FY26 to 28 or 29. Just trying to understand if I exclude all these and only on the base hospitals, probably now the base it's being dynamic in nature, so can't do much about it. But let's say if I exclude last 12 months additions, then subsequently whatever there's the recent comment, and we reaching at 80% occupancy. So in the next 2 to 3 years, is there still scope to grow and further increase the occupancy, or that becomes more or less the base, and so the addition of beds is what is going to drive the growth going forward?
No, see, your base hospital itself, the nomenclature changes. You see, whatever has been added really over the last 12 months or the 15 months has been acquisition in greenfield, right?
Yeah.
So, for example, what we are going to be growing in the next 30, 60 days, the 3 brownfields which are coming through, okay, in the next, let's say, 30 odd days, is going to be brownfields. So they add on to the existing facility. So then it's difficult to say that, look, in a brownfield, the earlier beds are growing by this much and the newer beds are going that much.
Fair. No, I'm just
right. So I think, yeah. So the take-up of this should be, although it's brownfield, the take-up should be very quick.
Understood. And so just secondly, on this international patient flow, which all other geographies, we've been sort of engaged with to get this such kind of high growth?
So I don't want to actually go into details of other countries, etc. Okay, because I don't want all the players going into those countries as well. But yeah, there have been newer geographies in some of the developing countries as well, developed countries as well, right? But of course, some time back we had guided you to the fact that we were opening direct-to-fly offices, right?
Right.
And to in other countries and so on and so forth. So that there was a focus towards international marketing and business, and something we had called out much earlier, even a few years back. And I think what has led is we've got increased traction through that strategy, and we've been doing more of that and being able to drive more and more patients.
Got it, sir. And just lastly from my side, in terms of net debt, given the projects at hand, without considering any inorganic opportunity at this point of time, because that will be as and when it comes,
Yes.
How net debt one should sort of think of at the end of FY26?
Yeah, so I think the net debt will go up to some extent because we have tied up some funds for the projects underway. So if I really say by the end of FY26, we may have probably addition in the net debt to the extent of around 400 to 500 crores.
200 crores, right?
400 crores.
4 to 500.
4 to 500.
So it will become net debt to EBITDA of maybe then still less than 1, I believe.
Sure. Thanks. That's it.
Thank you. Next question is from the line of Damayanti Kerai from HSBC. Please go ahead.
Hi, thank you for the opportunity. My first question is on your focus on the oncology segment. So this is largest for you, and year on year also I think it has grown up. So it's already 25-26% of your total hospital revenue. And I understand in newer hospitals also you are trying to offer these services. So in terms of further growth from current level, what kind of headroom do you think is available here?
So I think first and foremost, some of the newer hospitals, particularly Dwarka and Lucknow, both don't offer radiation oncology at this point of time. right? Because the bunkers are not there. But in the third quarter, we're expecting the bunkers to sort of come through in both these hospitals, and so therefore we see a larger share of oncology certainly in these, and that will make an overall sort of this thing as well. We don't believe that there is any sort of reason for the growth in oncology to abate. These are structural, and we are essentially catering to the market. Essentially the market is growing at what it is, and that is what is leading to increase in our share of oncology.
Okay. And do you think the kind of demand out there in the market and your leading position here, this therapy could be upwards of 30% in say few years from now? And why I'm asking, because I guess what we are hearing from your peers also, they are focusing a lot more on oncology compared to a few years back. So from that perspective.
I think to a large extent we can say we are focusing on it, but we are also all reacting to what is happening in the marketplace, right? And yes, we've seen growth in numbers in oncology, perhaps more than other specialities. And if you compound it at that, then certainly you will start increasing the market share of oncology, and it will be a higher sort of market share. It's been growing, and it's not necessarily that the new facilities that we acquired that has led to growth in oncology alone, because the newer facilities, like I mentioned, have a lower component at this point of time because of radiation oncology not being there. For example, Nagpur does not have radiation oncology. Lucknow did not have radiation oncology. Dwarka does not have radiation oncology. Okay, JP has, but that's really one out of the four. I think as and when, and like I said, when we are able to expand our suite of services, which is in Q3, in at least 2 out of those 4 hospitals, then the share should go up.
Got it. Thanks. My second question is on your newer hospitals, which will open soon. Say Nanavati will start in next few weeks or so, and then Smart is also coming up by end of this current quarter. So what is the status right now on the doctor hiring part? Like when do you onboard most of the doctors? Like before start of the unit, or you will add on gradually as you offer more and more services? And what kind of numbers you are looking at?
So all the brownfield expansions pretty much, offer the entire suite of services. So like I mentioned in my speech also, some amount of whatever was required for augmentation of these has already happened, particularly with both Nanavati as well as Nanavati, Mohali and Saket. But all three, and but incrementally as when you open more beds, so we definitely have whatever we believe, because again you're opening 400 beds, you're not opening 400 beds in day one. As in when you get the floors, you kind of open it up. But we have more than adequate sort of clinicians and already onboarded to be able to support what it is. Then incrementally you keep growing thereafter as well. But that'll be incremental, so you won't feel it. So whatever has been absorbed is absorbed. You will not see any impact because of that.
Got it. Okay, that's helpful. Thank you. I'll get back in the queue.
Yeah.
Thank you. Next question is from line of Shalin from UBS Group. Please go ahead.
Yeah, hi guys. Thank you so much for the opportunity. So, one question which I want to understand, you made a comment away also that direct cost has gone up, and it's largely because of the new units. So, but is this going to be stable from here? For example, I can see that your direct cost is 1,000 crore right now. From 917 has gone to 1015. So now the growth would be of this unit would be inflationary, or there will be more addition will be that, and the subsequent impact on the margin. So from Q4 to Q1, I understand this is seasonally weak, but if direct cost shouldn't go up, then one should expect margin to expand from here onwards meaningfully.
So look, as far as the direct cost is concerned, the significant majority of it is manpower cost. And on 1st of April, we have increased. Yeah. So, you get that step up because from 31st March to 1st April, you have that one little bump up because of salary sort of difference. But we also happen to be at this point in time and always maintain that, it's brownfields don't really impact. But, 30 days before or weeks before, when you're doing trial runs, etc., you have staffed. It may not necessarily only be clinicians, it's also people down the line. You staff for those sort of this thing, and you are kind of carrying that cost. So yes, I think going forward, at present, that cost, that little bit of cost may not be generating extra revenue, but it will do so as and when over the next few weeks these brownfields kick in. So yes, coming to your point, theoretically it should increase. Yeah.
And on the direct cost, specifically going to about 1,000, yes, so a bunch of doctors have joined, which is the part of the system that was pre-built up for the new capacities coming in. But a lot of them will join alongside when the capacities get commissioned phase by phase. They will go in tandem to the revenues kicking in as well.
Yeah, but there's no negative impact on the business.
No, nothing.
Yeah,
basically.
Shalin, also as we get into the newer quarters, I think as far as these hospitals are concerned, the share of the PSU bed will come down, right? Because you know that our strategy is to fill up the beds and then distill. So I think as we distill, this ratio should improve, right? Because you know that the PSU share has gone up because of the new beds, etc. And as we speak, the occupancies in hospital like Dwarka, which is started only 12 months back, I mean is 81-82%, right? It's because we said let's fill it up with whatever we had. Right. So once that ratios kind of improve, the percentage will also come down, the direct cost percentage.
Sure, sir. Because typically from when we move from Q1 to Q2, there is a sequential reasonable jump of 5-6% happens on the revenue. It may be more or less depending upon ramp up of the new facility. I hope it's more. But I don't expect, we should not expect direct cost to also move up in the same line, right? It may not move up. Right. So, yeah. So
as a percentage, they should be moderate.
Yeah.
That's right.
Yeah. Okay.
No, you're right. Your hypothesis is correct.
Correct. All right, sir. So we should expect a decent margin expansion then. This 12 crore thing, is it part of your CSR expense or is it outside of that?
No, so CSR expense is generally made by the companies, right? It's not made by the trust. So this is the money which is drawn out of the DDF society. Right. So this has been, on the recommendation of the board of governors, etc. So there will be some benefit that the network hospital will get out of this. But I think nevertheless, it's a one-time donation that has been made from the PDA society.
So this is a part of our indirect cost?
It's part of the indirect overhead, yes. At this point of time.
It's a one time.
Yeah.
The one time. So net. Yeah. So just wanted to ask because if it's a CSR, then it's not one time. So, but it's X of CSR, then it's a one time. So
there's no CSR in a society, na? In a charitable society, there's no CSR. CSR is only it applies to companies, right?
Right.
This money has gone out of the DDF society. So that's the reason why it's saying it's a donation, it's not CSR.
Basically, when I think about it, let's say everything remains same next quarter, then I should add back this 12 crore to the revenue, right?
Yes.
Or to the EBITDA.
That's right. So your 12 crores will never happen again. Yeah.
Yeah. So yeah, that's my 12 crore, which I can add back to my EBITDA, right? Next quarter. Everything remains same.
That's right.
Right, sir.
And all subsequent quarters.
All subsequent quarters. Absolutely. And the last bit, any color if you can give us on 2Q, how's it been going for you guys? Right, how's the season on the vector-borne, etc.? Typically, it's a strong season for us.
I'm going to avoid giving any forward-looking statements.
Okay. But
this year, normally I just sort of tell you. Normally, what happens is that towards the end of monsoons. Okay, the vector season this year has been a long monsoon. So only at the end of monsoon you start seeing it. You have to have stagnation of water for vector-borne diseases to kind of spread.
Got it. No worries.
Right. So normally happens when your monsoon kind of starts going down. But right now, I mean, it's been going up. Or not going up, but sort of continuing.
Sure. I think that's it. Good. Thank you so much, guys, and congratulations.
I think the important thing, Shalin, to look at is existing hospitals, okay, prior to any additions that we did over the last 15 months, okay, where there's a 7% growth in RPOP, and there's I think a significant increase in revenue and EBITDA as well. And occupancy has certainly gone up to 80% of those, right? Second thing to look at is the two hospitals which were added 15 months ago. Both those will have obviously a better sort of sense of maturity about them because they've been longer with us. Both these have also contributed to high increase in their occupancies. And in spite of both of them, you still see RPOP move up by maybe 5% and occupancies go up by a couple of percentage points. And then if I add the two hospitals, which one we really acquired in October, November, the other was a greenfield in July that we started. Okay, those have, in spite of those, we see flat occupancies on an overall basis. So it's not, I mean, the newer facilities haven't really dragged down our operations or our numbers by any significant distinction, and yet, they've provided us an opportunity as they mature.
Yeah, absolutely. I can see that. Great, guys. Thank you so much. I'll go back in the queue.
Thank you.
Thank you. Next question is from Viraj Shah from PGIM India. Please go ahead.
Hi.
Viraj, may I request you to unmute and proceed with your question?
Hi, am I audible?
Your audio is very feeble. Can you speak a little louder and through the handset?
Hello. Am I audible?
Yeah, go ahead, please.
Yeah, so I just wanted to know regarding the growth trajectory of the acquired hospital on revenue and EBITDA basis. How has it been post the acquisition?
You're talking about the Nagpur and Lucknow?
Including Lucknow, Nagpur, and also Noida. Go ahead.
Yeah, so Lucknow has been doing very well. On Y-on-Y basis, the revenue growth is 97%. EBITDA growth is 191%. Nagpur, we've grown the revenues by 27% YOY. The EBITDA growth is also in the same range. Noida has been a bit subdued, so the revenue growth is YOY. Again, this is based on the numbers that we have of the last year. These are not our numbers, but it's basically the numbers that we get from the Israel management. That's around 14% growth YOY, and EBITDA growth is 32% YOY. So that's the numbers.
Okay, perfect. Great.
All three, yeah.
That's it from my side.
Viraj, do you have any follow-up question?
No, that's it from my side. Thank you.
Thank you. Next question is from the line of Neha Manpuria from Bank of America. Please go ahead.
Yeah, thanks for taking my question. First question, Abhay, when does Nanavati, the new block, fully become operational? You said that we are currently operationalizing the, one of the floors and I think the basement. When can we see the unit becoming, let's say, fully operational from a bed perspective?
So the basement is not just the basement. Basement is also used for onco services and so on.
Onco.
Right? Yeah. So it's like the nuclear medicine department is in the basement. So let me kind of rephrase that. So we will be starting over the next few weeks, a couple of floors, and then we will transition towards by October, November. We should be starting the rest of the beds, including the OTs, etc.
Okay. Understood. And my second question is, if I look at the new units, numbers that you've given for fourth quarter versus this quarter, it seems like it's broadly similar to what we did in the fourth quarter. Is it because I thought that Dwarka had achieved break even last quarter, and that should be positive. So is it just a seasonality thing? Because I thought the seasonality isn't as stark quarter on quarter from fourth to first. And I would have expected that we see, or should I assume till the time we don't see Onco come in Dwarka, you won't really see that big ramp up happening?
No. I mean, on the contrary, seasonalities, you're right, are there, but for a new unit, there are no seasonalities because your growth momentum itself takes care of the seasonality and beyond. So we've seen very high ramp up of occupancies and everything at Dwarka. So I don't think we're waiting for anything to come in. In fact, we are already planning downfield at Dwarka because we are hitting factory out status over there.
Yeah, so Dwarka growth on quarter-on-quarter basis is 24%, which means that we grown the revenue from the quarter 4 FY25 to quarter 1 by 24%. The EBITDA is also 7-8 crores up than quarter 4, sorry. So Dwarka is no reason for anybody.
Yeah. And this thing, I think we are way past the break-even and any seasonality questions over there, etc. We are talking capacity out status.
Okay. And so in which case, then I'm wondering if, Noida could have done better this quarter, but, that really, because I would have assumed that, you'd see a much larger improvement, given the ramp up in Dwarka and also, Noida starting to, improve performance. So just trying to get a sense, is Noida on track with what we are expecting, or, should I expect an acceleration as we go through the rest of this year?
So we will certainly see acceleration in Noida as well. Okay, like I had mentioned, we acquired in October, November. Okay, the first couple of quarters are always the more distinct because you're kind of integrating it into your IT systems. We changed the name of the company. We bought it from LCLT. When we did that in this particular case, all the licenses, including transplant licenses, blood bank licenses, etc., we had to reapply for each one of these. So those have been coming through, etc. So it's literally we've been operating a little bit with our hands tied behind our back. And even again, this was a company from which has been in liquidation for many years. The equipment is out of life. We ordered all the equipment. They've been coming in phases. So all the building blocks have been put in this particular listing. So you typically what you have is that look in any acquisition that you do of this nature, the second year is better than the first year. The first quarter will always be the weaker quarter, right? Will be the weakest quarter because that's perhaps the time you have been able to implement the least amount of changes that you wish to. Because whether it's equipment, whether it's management, whether it's doctors, and so on and so forth, the onboarding does take 3 to 6 months. And like I said, in this particular case, it's almost like somewhere it's an acquisition that we did, but somewhere it was a greenfield kind of thing because we lost all the licenses, and then we had to sort of get them all renewed in new company and so on and so forth, and all of that. But yeah, most certainly what's going to happen is that going forward, okay, you're going to have a snowballing effect. You're going to have in the quarters to come, you should see significant upside there.
It's fair to assume that all of the grunt work that needed to be done for Noida in terms of licensing, equipment, etc., will be done. I mean, you should start seeing that from the subsequent.
It's already done. Yeah, okay. It's already done. But when you order this equipment, the supply chain itself, it comes from overseas. So there's a 6-month process from the day you indent it for you to get some of these equipment in place.
Understood. Yogesh sir, what did you mention the Noida EBITDA at? Sorry, I missed that number.
So Noida EBITDA is YOY growth is 32%.
Okay.
Right, and the revenue growth is 14%.
And would you have the absolute numbers for the EBITDA? Sorry.
I have the absolute numbers. It'll be around 24 crore rupees for the quarter.
Okay, thank you so much. That's helpful, sir. Thank you.
Thank you. Participants, you may press star and 1 to ask the question. Next question is from line of Kunal Dhamesha from Macquarie Group. Please go ahead.
Hi, thank you for the opportunity. Just continuing on the Dwarka and Noida thing, I think the total EBITDA contribution is around 23 crores or something. Or 27. Sorry? Total contribution for Dwarka and Noida, which we have mentioned, the new is 27, of which we are saying 24 is Noida, right?
No, so I think we'll also consider that, when the unit EBITDA will be 2.5% higher, because we also cross-charge the HO cost when we report numbers to the investors. But when you see a unit performance, then it'll be 2% higher in terms of EBITDA margin, right? 2.5% higher. There's 2.5% of the revenues allocated to units as HO cost.
So this 27 is unallocated.
This 24 that I mentioned is the unit EBITDA, right?
Unit
24
EBITDA.
crores.
Okay.
Yeah.
And which would come down to what, around 20?
By 2 crores.
Dwarka is
Yeah.
Dwarka you said 7-8, right? So
yes.
That's right.
Similarly, that's right.
Okay.
So this 27 number is after 2.5% of 231 crores being allocated to these units, right? So if you take out this extra cost, you add 5 crores to this 27 crores, 32 crores is the number combined for Dwarka and Noida.
Sure.
Okay.
Sure. Thanks. Yeah. Thanks. Second question on the ARPOB. You have suggested that including Lucknow and Nagpur, the ARPOB is around 4.9% growth, right? Excluding Noida and Dwarka. And then we are saying that the 3,500 bed that we originally had at 7%, that translates around 7% ARPOB degrowth for Lucknow and Nagpur. Is that a correct math?
No, so I know there's some confusion out there. So first of all, let's take the existing resistance hospitals, right? Without taking even the Nagpur and Lucknow, the ARPOB growth is 7%, right?
Yes.
These are the hospitals which are in operation, in December 23.
Correct.
Right. So if I take in the Nagpur and Lucknow, which is the hospital that we acquired in February and March of 24, then the ARPOB growth is 5%. Right?
4.9, which is what we are recording.
If I take Dwarka as well as the Noida, then the ARPOB growth is 1.2%.
Correct. So I'm saying that for a 3,500 bed to do 7% ARPOB growth, the ARPOB should have been degrown in Lucknow and Nagpur, right? Then only 7% comes down to 5%.
No, I'm not sure what you're saying, because there's no YOY number for the Dwarka, etc., right? Dwarka is there's no number for last quarter, right? In Dwarka.
No. Just exclude Dwarka and Nagpur, Dwarka and the thing. You have reported.
One second.
Yeah.
Look, there's no degrowth in ARPOB in any of the things. We only increase in ARPOB.
But then numbers are not basically connecting because 7%. Yeah, so 3,500 beds you are saying 7% ARPOB, right? And
yes,
then we include Lucknow and Nagpur, which is around 600 beds. Our presentation says that 4.9% growth or 5%, let's say, right? So then 7% is coming down to 5% by addition of Lucknow and Nagpur in the mix, which means
it's average revenue per occupied bed, no?
Correct.
I think you're already confused. Let me just give you the numbers, right? So just note these down. In the hospital which were operating till December 23, the occupied beds were 2,732. Right? If we take in the two hospitals, which is Nagpur and now, the occupied beds were 3,117. Right? And if we take Dwarka and Noida, the occupied beds were 3,556.
Okay.
Right? Now you do the math and
Yeah. I'll maybe connect offline on this.
Sure.
Yeah.
So, no, the other math will work out.
Sure.
Please get your formula straight. I've seen your formula and some of the other this thing is, in spite of us saying that occupied bed days have gone up and A-loss has gone down, I believe the statements have been made in your formula that our footfalls have come down for IPD. Theoretically, that's not even possible. So please get your facts right.
Sure. I'll do that, sir. Yeah. And then second question is, we have seen significant increase in institutional business, right? Even let's say because last year same quarter we would not have Noida or Dwarka, right? But there is a significant increase, and I assume that Lucknow and Nagpur are not the center for a lot of institutional patients. right? So
No, we started
why?
institutional in Bombay also. In view of the new beds coming, we've also doing in Nagpur. We started, was not there earlier prior to us takeover. It started last year. So is Lucknow.
Okay. But then existing beds, on the 3,500 beds, what would be your view? Is it more or less stable in terms of bed days from institutionals or?
So, Atin, for example, let's say Mohali, right? So, Mohali, we are adding 160 beds. So, you can't take institutional at that point of time, right? So, we take an institutional in the last quarter, right? And the occupancy has gone up, right? And we'll obviously, we are preparing for the new beds.
So is in Mumbai, because it takes you 6 months. It takes you 6 months to impanel yourself. Okay. Mumbai, for example, erstwhile there was no institutional business. Now we impaneled for institutional.
Sure. Sure. So wherever the new expansion is coming, it is more strategic.
That's right.
Yeah. Great. Thank you and all the best.
Thank you.
Thank you. Next question is from the line of Mohammed Patel from Edelweiss. Please go ahead.
I have a question on ARPOB growth. So it has been flat overall. So how should we think of overall ARPOB in the near term?
Well, it's grown. Existing beds have grown by 7%. If you add the two hospitals put up 15 months ago, then it's grown by 5%. If you look at all of the hospitals, then it looks flat. Of course, if you're going to start a new hospital or you acquire a new hospital, the ARPOB of that particular hospital is going to be lower, right? So it's going to bring the average down. Otherwise, both for existing and the newer hospitals, existing hospitals have gone up ARPOB and occupancy significantly.
So the overall ARPOB growth will take some time to reflect, right?
Mohammed, sorry, your voice is breaking. Can you please come in better reception area?
Is it better?
Yeah, so when you acquire a new hospital, you acquire it because it's lower ARPOB, and you acquire at that price. And the whole idea is to increase the occupancy and the ARPOB of that. Right? So going forward, you'll see ARPOB move up.
Okay, so eventually after a few quarters, the overall ARPOB growth will again start inching towards the high single digit.
That's right.
Okay. And my second question is, should we?
But, having said that, okay, it also depends where you're acquiring. We buy for ROC. We don't buy for, I may acquire something in a tier 2 city where the ARPOB is, let's say, half the present ARPOB. And that ARPOB of that place may never go up to my existing cluster ARPOB. The fact is, we have to figure out what ROC are we buying it at. If I'm buying it at a 20-25% ROC, if I believe I can get it to a 25% ROC, in spite of it having a lower sort of impact on the overall ARPOB, I still acquire it, right? I think the cadence you're looking at is incorrect. ARPOB by itself or a margin by itself, okay, of any capacity that you're acquiring or you're starting today, okay, is incorrect. What we have to see is, do we have superior return on capital profile over there or not?
Okay, fair enough. My second question.
I mean, let's say if I get an opportunity to buy a chain of hospitals which operates at less than half the ARPOB than overall operating at, and I'm able to buy it at a 25% ROCE, should I or shouldn't I? I should, right? What it would do is bring my overall ARPOB down, and I may never be able to climb up to sort of my present levels of ARPOB, so be it. Are we on the same page?
Yes, I get your point. My second question is, so should we expect EBITDA margin improvements in FY26?
You will expect improvement, but having said that, let me also tell you, and I keep repeating this, okay, EBITDA margin is incorrect sort of this thing, but because the higher payer mix, your EBITDA margin, my international business is growing by 32%. Supposedly, it's higher margin business in value terms. Okay, but in percentage terms, it's a lower margin business. When you do robotics, or you do transplants, or you do any of the high-end business, surgical business, okay, it gives you less margins in percentage terms, but it gives you more in value terms. Please consider EBITDA per bed as the right cadence, and not EBITDA margins.
Okay.
So one end, okay, because of better occupancy, okay, at one end, because of better occupancy, higher utilization, and so on, your margins will increase. On the other end, because you're going for a superior payer mix and a superior clinical mix as well, okay, your margins should decrease because of that. Right? But your EBITDA per bed will increase. And your ROCE will increase.
Mohammed, do you have any follow-up question?
No.
Mohammed, are you with me on this?
Yes, I'm with you.
Okay.
Thank you.
Thank you.
Thank you.
Next question is from line of Sujit Shah from SK Enterprises. Please go ahead.
Am I audible?
Yeah, we can hear you.
Yeah. Firstly, I want to appreciate the entire Max Healthcare team. At this scale, expanding so rapidly while maintaining profitability is not easy task. And my all question is already asked and answered, so not any question I have to ask.
Thank you.
Thank you.
Thank you very much. Ladies and gentlemen, next question is from line of R. Gajra from Informous Media. Please go ahead.
Hello, can you hear me? Am I audible?
Yes,
Yes, we can hear you.
Yeah, you earlier in the call you mentioned that at the end of FY26 the net debt will be, and you gave some figure for that. I was not able to catch that number. Can you please repeat that? The net debt level at the end of FY26. Thank you.
What Yogesh mentioned at the end of the year, between now and end of the year, your total debt for project purposes may go up by another 400 to 500 crores. May go up to 400 to 500 crores.
Okay, all right. That's it. Thank you very much. Thank you.
Thank you.
Thank you. As there are no further questions, I'll now hand the conference over to the management for closing comments.
Thank you once again. We appreciate all your time and look forward to connecting with you next quarter. Thank you so much.
Thank you very much. On behalf of Max Healthcare Institute Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.